Hey, good morning, everyone. Marty Missouri here with your weekly economic report. It's Friday, May 6, 2022, 8:41 a.m. Pacific time. So we'll talk about the slight upward move in our index. I'll show you a handful of inputs and we'll do a quick technical update on the S&P 500. So we went from 8.7 to 10.7, so a slight 2-point uptick in our economic conditions index. So that was positive, but nothing really inspiring underneath there to say the economy is about ready to resume at a faster pace of growth than what we've been seeing here of late. We've been seeing growth slow. I'm catching, a rise in commentary from certain economists of late that are beginning to project or predict a recession sometime soon. Certainly open to that possibility, certainly can see the risk rising when we do our own assessment of conditions. But no, that's not going to be our position here just yet. Right now, our position is that the expansion continues. So we'll run through, again, some of the inputs. There's 46 in total that go into our index, and then we'll take a look at the stock market. To start out with auto sales, we see a slight uptick in the estimate for April auto sales in the US. However, reading through some of the commentary from consultants in the space, I'll read from this Market Watch article. Sadly, no major signs of improvement to report in the new car market in April. We are seeing the same trend from Q1 carry into the second quarter. Inventory continues to be low, leaving consumers perturbed by high prices and little selection. The realities of the market are a stark contrast with automakers trying to drum up excitement around this year's EV launches. Supply chain issues, including chips and auto parts storage, are really putting a damper on the momentum and buzz of the market. So essentially, slight uptick, something worth noting, but the underlying conditions have not really improved measurably, if at all, since March. Mortgage purchase applications actually rose a little bit. Didn't change our score, but worth noting that week over week, an increase in mortgage purchase applications. Jobs numbers, wrote about that briefly on the morning note. 428K, 58K, I believe it was better than expected. However, previous month's revisions kind of offset that. Unemployment rate remains at a low 3.6%. Average hourly earnings holding up, although as I suggested, the rate of change was a little less than anticipated. The JOLTS report, job openings and labor turnover, there's a lot in that report, but today we'll just focus on the job openings number, which is 11.5 million, which is big. And then the quits rate, 3.0. So that's a very high, historically high quits rate. High quits rate means that people are willing to just leave their jobs, and they don't do that by this definition unless they have something better in the offing. So, take a look at what job openings tend to look like, right, during recessions or leading into recessions. These red areas are the last two recessions, right? And then quits rates. Of course, people need to keep their jobs. So, despite what some economists are now beginning to predict about the economy, and as I keep saying, the labor market's not perfect. We look at a lot of different surveys, and some of them are showing some concern, like the household survey. But on balance, it's not screaming recession, not remotely, at least at this point. The purchasing managers indices, the manufacturing and the services, these are huge. These are really, really important. And as you can see, they've been going in the wrong direction of late. Let me read to you directly from the manufacturing survey for April, which came out this week. First of all, the person who oversees this one tends to give you a summary, and here's that summary. Manufacturing performed well for the 23rd straight month, with demand registering slower month-over-month growth, likely due to extended lead times and decades-high material price increases, and consumption softening due to labor force constraints. Overseas partners are experiencing COVID-19 impacts, creating a near-term headwind for the U.S. manufacturing community. 15% of panelists' general comments expressed concern about their Asian partners' ability to deliver reliably in the summer months, up from 5% in March. So I've been talking about China quite a bit of late, and the fact that President Xi has chosen to try to exercise the same strategy for the first variant or two of COVID, and it's not going to work with Omicron. So they're doing these huge lockdowns. Everybody's testing. I believe the hospitalization and the death rates, like everywhere else with regard to Omicron, are really low. But there's this kind of, this attempted show at political force and leadership ahead of his, pending reappointment the second half of this year. So our take is that they will have to abandon somehow and claim victory on this zero COVID policy sooner than later, and that they will inject a tremendous amount of fiscal and to some degree monetary stimulus into their economy. They're already talking about that. We had a huge pop one day last week in Chinese stocks because Xi came out and said, we are just going to, pound on infrastructure. My words, not his. So when that begins to develop, when we get the real details in terms of what's going to be happening there, I suspect that what has been somewhat of a pain trade the last, say, 5 weeks or so, and that's our commodities exposure, probably will come back rather nicely, leading into and during the second half of the year. That's our thesis as we sit here today. A lot of times on the written blog, I'll feature what respondents are saying. This time I'll just kind of, just maybe peruse through these. The chemical products industry, shutdowns in Shanghai are causing a ripple effect for our suppliers in other parts of China, long delays at ports, so on and so forth. Transportation equipment, continued strong demand with improvements in the supply chain, believe it or not. Delays still exist, but supply issues are slowly improving. From the food, beverage, and tobacco products industry, supply chain is still constrained and prices continue to rise. Machinery, new order entries are still very strong. Unfortunately, logistic issues have not yet improved. Due to electronic equipment supply chain issues, and this is fabricated metal products, production output has been lower than normal. Backlog is growing due to the supply chain issues and so on. So you're starting to see some hints that that's getting better, but there's other industries that's just saying, they're just not seeing the improvement just yet. And then on the services, the yellow line here, which has declined as well. And by the way, above 50 denotes continued expansion. Below 50 is where you really start thinking recession. But again, we need to take a look at the direction and the rate of change. So among the services industry, accommodation, food services, pricing pressures, and product availability issues continue to be extremely problematic. Among construction, mortgage rates have, quote, skyrocketed. While relatively low from historical perspective, the new rates combined with historically high home prices will temper new home demand at some point over the next 12 months. And then let's see, educational services, large construction projects have been mostly constrained due to continued supply chain issues and large cost increases. Shortages in account management continue to be a source of frustration for day-to-day operations and services. Healthcare and social assistance restrictions lifted as COVID-19 case volumes drop, allowing for more elective procedures and reduction in average length of stay. Business remains strong according to the management of companies and support services, only dampened by shortages in labor, increased material costs, and so forth. So clearly, folks, mixed results. And as our overall assessment suggests, with kind of a downward bias in terms of economic conditions. So I get why economists want to get out in front of that and be known as the ones who forecast the next recession accurately. We don't want to do that. We just want to look at the data and, most importantly, assess global risk, where it lies, where we need to defend against, and where the opportunities lie amid these volatile periods. Heavy truck sales saw a slight increase. That would be viewed as a positive. Global PMI dropped to 51.0. So again, that shows declining economic sentiment across the globe. And then copper. So again, folks, can't say that this should be a surprise to anybody who's been watching the videos. These big moves were, unsustainable. Copper is very sensitive to goings on in China. Still, historically very high. I'll say it again, if there's one place to be exceedingly bullish over the next few years, it's copper when you think about its application across everything that has to do with building and construction and everything that has to do with renewable energy. China opens back up and starts spending on infrastructure. I highly expect that we will do very well in our copper exposure, our miners exposure, our materials exposure, and so on. Okay, so folks, that's it for the economic update. Let's run through quickly the usual on the S&P 500, and I promise we will get into other things, currencies and precious metals at times, but just with all the volatility of late, seems like we should focus right here on the US market. So that very short-term 60-minute chart, recall day before yesterday, sure enough, I was pointing to this pattern right here and these divergences and said that, yeah, it looks like we could see a breakout. The buy signal would come right on the breakout at a really nice pop. And that was, the day that Chairman Powell spoke. We had the Fed policy meeting conclusion. And then the next day we just fell off the cliff, so to speak, and came in lower than we were right here. Now we're dancing on top of this trend line. So on the hourly chart, we're finding support on that downward trend line. So traders came in right where the rallies have died the past 3 times they hit that level. Made perfect sense. Remember, I talked about swing trading, right? Here you go. Short the market here, go long the market here, right? Have your stop loss sells here, have your buy stops here if you're short, somewhere up here. And you've got the swing trade, and that's been a pretty good way to live if you're a short-term trader, and that's not something that we suggest people try. But it does pay to look at these things and maybe anticipate, in case you're getting freaked out, where we might see some support. Now, we do that for our purposes, more importantly, on the longer-term charts. Looking again at the one-year daily chart, as I showed you last time, these bullish divergences, and I'll show you those here in a second, suggested that this particular flag pattern right here, well, this one here came in really, really close, right in here to the price target. Then we had this one develop. So here was your flagpole, right? You extend that flagpole down for your next price target, which ironically stuck us right at 4,000. And we didn't quite get there on a intraday basis. And we bounced off of that and then lost it right at this thick, bold red, now resistance line, right? Broke down through this, what could have been support, right? The fact that it's bumping up against that and losing it, that's not good. And then the momentum indicators, we do still have, for the moment, bullish divergences here. We've been all over the place today. We were down, I think, like 1.5%. We were actually up here just a few minutes before I started recording here. And right now the S&P 500 is down almost 1% again. So folks, this is a trader's market. No ifs, ands, or buts about it. Clearly, the big rallies have been getting sold into. On the weekly chart, folks, this is just not a good look on the momentum indicators. On the price chart, remember we've gone back, I did this day before yesterday. This pattern that's forming up in here basically says, from a 30-year historical perspective, that we're going to go down and test this 200-week moving average, which now would be, let's see, I did this, yeah, call it, yeah, from the bottom of that candle wick there, call it a 15% decline on top of the 13 or 14% that were down already. So call it a 30% decline before thinking about the worst is over. We could bottom right here. There could be some news, what have you, a big change, in geopolitical happenings and so forth, that could ultimately produce a durable bottom for a while, but we're not seeing that just yet. And we're just brand new into a new month right here. To remember the monthly MACD sell signal, which again historically virtually assures that we're going to test that 50-month moving average, which from top to bottom this year, call it a 30% decline, looks very doable here. Folks, again, went longer than I anticipated. Hope it was helpful. Have a wonderful weekend. Take care. Bye-bye.